Okay, let's jump right into it. We're doing a deep dive today into something that's definitely weighing on a lot of minds. Navigating potential economic uncertainty. Specifically, we're looking at the signals that seem to be flashing recession and, more importantly, what your sources lay out as practical financial strategies. Right now, we've got quite a bit of material here, recent market data, some economic analysis, and honestly, some really strategic personal finance guidance. Our goal today, pretty clear: cut through the noise, pull out the most important insights, the actionable steps from all this stuff so you feel informed, prepared, not panicked.
Exactly. And the sources, they do point to economic signals that are, well, flashing some warning signs. Understanding why they're concerning, that's really the crucial first step,
Yeah.
before figuring out how to navigate it all effectively.
Okay, let's unpack that. What are these signals, based on the material you share, telling us? What's been happening in the markets?
Well, the sources definitely highlight significant volatility and some clear downward pressure at times. We saw, for instance, major U.S. indexes drop pretty sharply back on September 3rd, 2024. A big driver that the sources pointed to was the weak manufacturing sector. The Purchasing Managers Index, the PMI.
Yeah.
For August, it actually contracted to 47.9.
Right, and anything below 50 means contraction.
Exactly. So that number was a clear negative signal. It wasn't just one area. The sources mentioned specific companies seeing losses that day, like industrials think Caterpillar, 3M, and even tech like NVIDIA. Shows how broad the impact was felt.
So that manufacturing weakness really hit home then.
It did. And, that came after earlier weakness we saw in August 2024. Wall Street had about a 3% drop then, driven, according to the sources, by some disappointing results from, well, some of the biggest tech companies.
Ah, the big tech influence.
Yeah, and the NASDAQ being so tech-heavy, it led those losses. That really raised concerns about, a potential slowdown filtering into major parts of the economy.
But then, hang on, the sources also mentioned markets recovering later that same month. How does that fit in? Seems contradictory.
It really shows the mixed signals of volatility we're talking about. It's not a straight line down. So, on September 27th, the Dow Jones actually closed higher, up 0.33%.
Okay.
And this came right after some more moderate inflation data was released. The PCE index, that's the personal consumption expenditures, the Fed's preferred gauge.
Yeah.
It showed annual inflation at 2.2% in August, which is actually the lowest rate since early 2021.
Wow. Okay. So some good news on inflation then.
Exactly. So that provided some relief. Now, even though the S&P 500 and NASDAQ were slightly down that specific day, the key thing is all three major indexes ended that week with gains. It's a landscape of conflicting data points causing these market swings, up and down.
Okay, so the market reactions are kind of all over the place, bouncing off manufacturing data, tech earnings, inflation numbers. What about the broader economic picture the sources paint, especially as we look towards more recent times like May 2025?
Yeah, fast forward to May 2025, and the assessment in your material is that the U.S. economy is, well, definitely showing signs of strain. The Federal Reserve's latest report, for example, indicated nearly half of its districts are experiencing contraction or stagnation. Only a few reported, like slow growth.
Nearly half. That's significant.
It is. And then you add other factors. The sources mention how global trade tensions are sort of reigniting. They cite President Trump's recent announcement of a 50% tariff on European Union goods.
Right.
And that kind of geopolitical move, according to the analysis provided, just adds another layer of uncertainty. It contributes to market volatility. We're just reporting what the sources indicate here as factors.
Okay. So when you put all these pieces together, the slowing manufacturing we talked about, the concerns from tech, these volatile market swings reacting to different data points, the Fed reporting broad economic strain, and these renewed trade tensions. It sounds less like just, speculation and more like concrete signals that experts are looking at the real possibility of a recession.
Precisely. These are the kinds of indicators, all combined, that lead analysts in the sources to use that word. And the impact isn't just numbers on a screen, right? The material connects these high-level points back to the stress Americans are feeling. Things like climbing consumer debt, ongoing layoffs being reported, and inflation that just continues to stretch budgets.
Okay, so this is where it gets really interesting for our listeners because the sources pivot. They shift from just observing these signals to saying, look, you don't need to panic about this, but you absolutely need a plan. They actually lay out actionable strategies for you listening to navigate this kind of uncertainty.
Exactly. This is where the rubber meets the road, so to speak. The sources shift focus entirely here to practical steps, things you can actually do to protect your finances, and maybe even find some opportunity during these challenging economic times.
All right, let's dive into those. The sources really, really hammer home the importance of having liquid cash. Why is that so foundational? What does that actually mean for someone right now?
It's basically about prioritizing your cash flow over, say, your net worth calculation, at least in the short term. See, during a downturn, your assets, investments, they might drop in value on paper. But your ability to cover your bills, your day-to-day expenses, with money you can access right now, that becomes absolutely paramount.
Makes sense. Survival mode almost.
In a way, yeah. And the most critical step, emphasized across several of the sources, is building a significant emergency fund. Ideally, they say 3 to 6 months worth of your essential living expenses.
3 to 6 months. Okay.
Think of it as your immediate safety net, your cushion if your income gets disrupted for any reason.
So how do you build that buffer, especially if things are already tight?
Well, the guidance points towards aggressively cutting non-essential expenses. They give examples like, really looking at all those streaming services you might be subscribed to but barely use, or just generally monitoring all your spending much more closely. There's a mindset shift mentioned in one source that's key here. The focus needs to be on protecting your income and making sure you have cash available next month, not just focusing on long-term wealth accumulation like 10 years down the road. That comes later.
Protect next month's cash flow. Got it. Okay, so building that cash buffer is step one. Now, given the job market uncertainty the sources mention, how do they suggest protecting your actual income stream? Relying on one job feels shaky.
Yeah, it can feel shaky. So they strongly recommend diversifying your income. This could mean developing what one source calls a recession-proof side hustle.
Recession-proof, interesting term.
Yeah, or just finding additional ways to earn money beyond your main job. Another source backs this up too. Diversification.
What kind of side hustles do they suggest?
Well, one source lists several types that tend to hold up, or maybe even thrive, in downturns. Things like freelance services writing, graphic design, virtual assistants, skills people still need. Tutoring or online teaching, because learning and upskilling are always in demand. Delivery services, ride-sharing, even selling used goods on platforms like Facebook Marketplace. Things people turn to when budgets tighten. They also highlight online avenues like affiliate marketing or content creation. Those often have low startup costs and, potential upside.
Okay, lots of options there.
Yeah, but a crucial piece of advice stated very clearly in one source is to start exploring this while you still have a stable job.
Don't wait until you need it.
Exactly. Don't wait until you're in a desperate situation. And another source mentions practical platforms like Upwork or Fiverr as places to actually find these kinds of opportunities.
That proactive approach makes total sense. Don't wait for the storm to hit before you start building the ark, right?
Precisely.
Okay, now, investing. You mentioned market volatility earlier, which sounds terrifying to most people, but the sources suggest there might be opportunity here.
They absolutely do. And it's a common theme in investing, actually. While falling markets can feel scary in the moment, one source makes a strong case that these periods are historically when long-term investors can actually make their best investments, buying low, essentially. But the key is strategy, not panic selling. That's the worst thing you can do.
Okay, so what strategies do they recommend?
So the sources suggest a few specific approaches. If you're newer to investing, sticking to broad-based index funds is often advised. Less risk follows the market.
Right.
Using dollar-cost averaging is also highlighted. That means investing a fixed amount regularly, say every month, regardless of whether the market is high or low.
Smooths out the bumps.
Exactly, or reduces the risk of putting all your money in right before a dip. Focusing on dividend-paying stocks is another suggestion for generating some passive income, even if the stock prices themselves fluctuate. A little cash flow cushion.
Okay. And ETFs were mentioned too.
Yes, ETFs, exchange-traded funds, which are often similar to index funds. And generally, just stressing the importance of maintaining a long-term diversified portfolio. Don't put all your eggs in one basket.
And what should people avoid doing with their investments right now?
Good question. One source specifically warns against trying to time the market perfectly. It's nearly impossible. Also, avoid speculative day trading or going all in on, volatile hype stocks based on what you read online.
Got it. Discipline over hype.
The emphasis is definitely on disciplined, long-term strategy. Boring can be good in investing, especially now.
Okay, so beyond income and investing, the sources also strongly advise getting proactive about your expenses. Not just the non-essentials, but the big stuff.
Yes, this is about reducing your fixed costs and doing it before economic conditions potentially tighten further. One source argues that once a recession really hits, your ability to change major expenses like housing is often much more limited. Landlords might be less flexible, for example.
So act now. What kind of fixed costs are they talking about?
They list some really concrete examples, uh, exploring if you can renegotiate your rent, or if it's feasible and necessary, maybe even moving to a less expensive area or smaller place, shopping around for cheaper insurance car, home, renters. Rates can vary wildly. Canceling subscriptions or gym memberships you genuinely don't use. Be honest with yourself. Even switching to generic brands at the grocery store can add up significantly over time.
And the idea is to free up that cash.
Exactly. Free up cash that can then be redirected towards building that emergency fund we talked about, or maybe funding those side hustle experiments.
Makes sense. And this ties into debt, right? The sources seem pretty strong on avoiding debt.
Very strong. One source calls debt a multiplier of stress, especially when your income might become less certain, and interest rates can remain stubbornly high even if the economy slows.
So what kind of debt should people be particularly wary of right now?
Well, definitely high-interest credit card debt. That's a killer.
Yeah.
They also warn against overusing buy now, pay later offers, especially for things you don't truly need. It's still debt. And they advise caution on taking on large new debts like big car loans or new mortgages, unless it's absolutely unavoidable and carefully considered.
Okay, avoid new debt. What about existing debt?
For existing debt, they suggest strategies like the snowball method that's paying off your smallest debts first to get some quick wins and build momentum. Psychologically helpful.
Right, the snowball.
Or, if possible, consolidating high-interest debt like credit cards into a lower-interest loan or balance transfer card if you can qualify and manage it responsibly. Another source also emphasizes just prioritizing paying off the debts with the highest interest rates first, like credit cards, because they cost you the most over time.
Tackle debt/fix costs proactively. Got it. The final strategy feels a bit different. It's about investing in yourself. How did the sources frame that during uncertain economic times?
Yeah, this one's interesting. One source argues this might actually be the highest ROI, return on investment move you can make right now. Their point is that in a slowing economy, companies aren't just hiring fewer people. The people they keep need to be more valuable, more skilled, more efficient.
Become indispensable, basically.
That's the idea. So they suggest things like taking online courses, and many are free or low cost, to learn high-demand skills, especially remote-friendly skills.
Like what?
Things like advanced Excel, copywriting, coding basics, digital marketing, maybe data analysis, skills that businesses consistently need. They also advise spending time actively improving your resume and your LinkedIn profile. Keep them sharp. And even practicing job interview skills, even if you're currently employed. Just stay prepared.
Practice interviewing even if you have a job. Interesting.
Yeah, the core takeaway is enhancing your skills and clearly demonstrating your value is probably your strongest form of job security in any economy, but especially a tough one.
That makes a lot of sense. Okay, so just to recap the plan based on these sources, it's a comprehensive approach. Build that cash buffer, diversify your income streams, invest strategically for the long haul while avoiding speculation, aggressively lower fixed expenses, and manage debt proactively, and continuously invest in making your own skills more valuable.
That sums it up well. And there's one final point from the sources about staying informed.
Right.
One source specifically mentions just keeping up with economic developments through reputable news outlets. Understanding the broader context, helps you make more informed decisions for your own situation. It helps you anticipate potential shifts maybe a bit better.
Good point. So we've looked at the signals flashing in the market and the broader economy, and we've walked through a pretty powerful plan based directly on your sources, covering cash flow, generating income, strategic investing, lowering expenses, managing debt, and boosting your skills. That's a lot.
It is a lot, but the core message that comes through really clearly, particularly from one of the sources, is this. While the economic landscape, it might present challenges, proactive financial management is really your best tool to mitigate the risks. Financial resilience, they emphasize, it isn't magic. It's built through informed and consistent actions over time.
And the sources leave us with a final kind of provocative thought to chew on.
Yeah, one source frames it this way, which I thought was quite powerful. It says, a recession is often a reset, not necessarily the end. While it can be really difficult for many, historically these periods also create like once-in-a-decade opportunities. New businesses often emerge, markets eventually recover, sometimes very strongly. The difference often lies in how people respond, right? Some panic, while others choose to prepare and actually position themselves for that recovery. Some even profit.
Prepare, don't panic. So if we distill it all down, the ultimate guidance from this material seems pretty simple at its core.
Yeah.
Stay liquid, stay learning, and stay earning.
Well put.
And remember that line from one of the sources that really stuck with me. You don't need to be rich to survive a recession. You need to be strategic.
Yeah.
So the question for you listening, based on everything we've dug into from these sources today, is what specific strategic step will you take this week?